But yeah, without further ado, Mark, it's wonderful to have you here with us today. Really appreciate it, Mark, from Plus Accounting. Mark, do you want to sort of introduce yourself and tell our viewers a little bit about what you do, and well, I guess kick things off in terms of what you're going to be covering today.
Yeah, absolutely. Thanks, Leo. Hi, everyone. So my name is Mark Horsfield. I'm a business services manager for Plus Accounting. We're a firm of chartered accountants. And today I'll be covering the topic of tax relief schemes relating to video games. So there's the VGTR and VGEC schemes, which I'll be diving into more details about what they are, how they work, how you make the claim for them. There's also touching a few other subjects as well related to tax and finances. So yeah, that's what we'll be covering today.
Tremendous, wonderful. Well, thank you so much. I really appreciate it. Do you want to share your screen and get your...
Yeah, so mention myself, and just to mention briefly about Plus Accounting. So we're a accounting firm, independent accounting firm based in Brighton in Sussex. We provide accountancy, audit, and tax and outsourced services to a range of clients, both sole trader and limited companies, and for personal tax services as well. Reason I'm talking to you today is because one of the areas which we specialize in is video games accountancy services, including video games tax relief claims. We have over 250 clients in the video game sector. This ranges from sole traders, contractors, small studios and medium-sized studios, ranging from when they've startups to long-established studios. So we've dealt with and got plenty of experience for a number of years in helping accounting for video games clients, and part of that as well is built up a long-established network of professionals in the video game sector. So if you ever need any other advice relating to video games, we always got someone we can refer you to, whether it be legal, HR, and finance. And so we always got you covered as many areas as we can for our video games. So just to list out the topics I'm going to cover today for you. So I mentioned briefly the video games claims. So I'll be running through what they are and what they mean. I'll be doing a comparison of the VGTR and VGEC scheme available. I'll explain how the claims are made. I'll give you some information regarding other considerations relating to the claims. Also touch upon other stuff like VAT, corporation tax, cash flow considerations, and obviously there'll be Q&A at the end. So that's everything I plan to cover, and hopefully have enough time for everyone to listen to. So kicking off firstly with the video games tax schemes. So just to give you a brief overview of what they are. So they were first introduced in April 2014 by the government, by HMRC. And the idea is that they look to support the video games industry by giving either payable cash credits or reducing corporation tax bills for those video game studios which are developing a UK-based game. So they're only available for UK limited companies. And the two schemes that are currently available are the Video Game Tax Relief Scheme and the Video Game Expenditure Credit Scheme, which I will go into more detail shortly. But yeah, that's the sort of brief overview background. It's essentially a tax initiative scheme by HMRC to try and support this industry, which is a very vast industry and has been growing for a number of years. So it's good to get that sort of support there. So who are they available to? So they are solely based to UK-based game development companies. They have to be a limited company. They're not available for any sole trade or partnerships. You have to be liable to corporation tax. So quite often we'll see an individual who's developing their own game in their own time, which you might plan to make use of this scheme at a later date. You will at some point, to be able to make use of the schemes, be able to incorporate yourself as a limited company. So it has to be limited companies. It won't apply if you're doing stuff under your own name or you're in a limited liability partnership or a regular partnership. Those will be available to you. Key point regarding the claims is there's only going to be one development company per game. So what I mean by that is you quite often might have a sort of co-productions for games, but the claims that are available are only going to be for that one development company, which is solely responsible for designing, producing, and testing that video game. So ultimately, it's your game, and you're taking the lead on it. So you're actively engaging in planning and decision making around the design, production, and testing stages of that game. and also that you're directly negotiating rights, goods and services related to that game with publishers and things like that. So ultimately it's your idea, your game, and you have active involvement throughout the whole game development. So you can outsource certain areas to help with game development. There are a number of firms out there who offer just that in the case, specialized subcontractor services. But the key for you to be able to make a claim is to make sure that you're actively involved from start to finish of that game. As I say, there's only going to be one lead production company, and that you have to sort of establish that first of all. If there's one or two of you involved and you've got different companies involved, you need sort of a lead development company to be able to make the claim. Moving on to what sort of expenditure you can include the claim. So what they define that as is going to be core development expenditure. So the way they describe it is the designing, producing and testing phases of that game. So initially you might have a sort of a pre-production process, normally based around coming up with the initial concept of the game. That sort of stage of the initial concept and work around that is not the point which you'll be able to make a claim for. You only can start claiming costs when you sort of get a green light and sort of agree to go ahead and prepare and, you know, produce this video game. It's not a sort of an idea of, yeah, we've got this idea, we'll just see if it works. That sort of stage won't be eligible for the claim. It's the point we go, yes, we've come up with this idea, we're going to go ahead with it. That's the date in which you can start making, you know, start making the claim and claiming expenditure relating around that. So that's the crucial bit. You'll need to establish is the date in when you sort of get that green light to go ahead with the production. There's a number of excluded expenditure for the claim which you wouldn't be able to include. Marketing and distribution. So you only can claim at the point in which you sort of finish the game and release it for public use, public sale. Anything related to you trying to promote or advertise the game wouldn't be eligible cost for the game. As well as that, there's also hardware costs. So if you build up a team of developers and for employees and you buy them hardware, computer, laptops, that sort of thing, those sorts of costs wouldn't be allowable in the claim. Any post-release bug fixing or maintenance or general maintenance of the game. So quite often and not we see where a game has been released and is available for playing and purchasing to the general public. Now, if you're still doing stuff to the game and developing new features, potentially, even though you might have released the game, you still might be able to make claim on those new features. But if you're doing work just regarding any bug fixing, which users have identified once they're playing it, or any sort of general maintenance of the servers and that sort of stuff, those costs you won't be able to claim. But if you are doing post-release development of new features and things like that, you still, even though you might have released it, still might be able to make a claim. So you can have a claim going on multiple years as long as you carry on developing the game. You still might be able to make a claim on those. Something else to exclude is dividends, and it's quite relevant for those who are sort of is your personal company. So it's quite often or not that a personal company, you have a remuneration structure through sort of low salary and high dividends to be tax efficient with your income. If you're looking to claim your time and your cost in part of the claim, you won't be able to include dividends there. So you might need to consider what the cost benefit ratio would be if you were to bring in your own time for a PAYE salary, and your personal tax implication from that and the dividend tax that you lose out from that. So yeah, if you were looking to bring in your own time, you need to be on a PAYE payroll structure and not have it through dividends. Dividends wouldn't be allowed to be included in the game. And finally, one final point relating to excluded expenditure. I've wrote there the 4-month payment rule. So that's quite crucial in terms of being eligible expenditure to claim. So quite often not like a salary, if your remuneration package is a salary, unless you've actually paid that within 4 months of the year end, you won't be able to include that in the claim. So if you were, for instance, a couple of scenarios where you might have your own payroll going through, but because of cash flow reasons, you're not able to pay yourself. So even though you're still processing the payroll and you might be putting a gross salary in, so it's salary costs for the game, unless you actually have paid yourself that salary within 4 months of the year end, so you might have a December year end, you have to have had it paid by 30th of April, wouldn't be able to claim that cost on there. So it's the same as well if you're using sort of external worker, contractors come in and you've agreed that you won't start paying them until the game's been released and it's got income in to come in. And although they might have accrued costs because of development work has gone up through the whole process, unless you've actually paid them in that period, you won't be able to include those claim costs in the claim. So that's quite a crucial point, and really sort of an anti-avoidance rule from HMRC to make sure that people are not just accruing for cost in the game expenditure, not actually paying it, but getting an enhancement and claiming a tax credit based on costs they haven't paid for. So it's quite a crucial point, if anything is relevant for that. To give you some quick examples of the claimable costs that usually go in the claim, generally these are the most common ones: staff wages, national insurance, and pension costs. That's the main bulk. If you've got a team of people and they're staff members, that's the main cost. It's mostly their time that you bring in. If you're doing multiple projects at the same time and staff are doing flip-flopping between different projects, you would sort of allocate a percentage between project one and project two, make sure you apportion that fairly. And that's, so one of the main bulk costs you can usually bring in. Subcontractor costs, so anyone outside the organisation, you can bring in to claim for that as long as they're solely working on sort of core development work. Again, not related to excluded stuff like marketing and advertising and things like that. So as long as they're working on a specific part of the game, you can bring those costs in. IT software and subscriptions, if they're bought solely for software relating to the game, you can claim that in full. If it's general admin software, it can be like email subscriptions and things like that. Adobe, often they'll have an element of claimable proportion you can bring in. So as listed as well there, percentage of overheads, which can apply to like bank charges, accounts fees, travel assistance, stationery, those sorts of things there. It's always worth bringing in a percentage of those. So even though they might not be directly linked to the game, you can still bring a percentage of overheads in there to making the claim. So it's really about trying to maximise the most amount of allowable expenditure you can, and claiming the percentage of overheads, claiming your IT software and staff wages as subcontractors is the main bulk costs that you have. So yeah, they're the main features of the claim costs and what you can bring into it. Screen, yeah. So moving on to the first scheme that I'm just going to discuss quickly for you, the video games tax relief claim, VGTR. I'll keep saying VGTR rather than me saying the long version, so you don't get bored of that. How it works is, so developers can claim 80% of core expenditure and EA spend, so the lower of those two. So EA spend is the European Economic Area, so that's the old scheme, and it was eventually, we were part of the EU when we set this scheme up, so it still applies to EA spend. What they give you is a 25% tax credit. So it works out a net overall, once you've taken the adjustments and calculations, result of 20% net return on your cost and investment there. So essentially 20% of your cost base is returns for you. So it's quite a significant sum that can be repaid from HMRC. Non-EEA spend, so anyone outside the European Economic Area or outside the UK, won't be eligible for the additional deduction. So essentially, even though it might be cost related to the game, if it's not included in the UK or EEA, it wouldn't be eligible for this enhancement, and therefore wouldn't get this tax credit from that. So it's quite a big factor if you're working with a number of contractors based outside the UK, and you're eligible to use this scheme. You will have to, if you've got a choice between the two, even though a US based or someone else, Singapore based, whatever it is, might be slightly cheaper, if factoring your European contractor would mean that you'd be able to get 20% result back from it, it might change your mind about who you use and things like that. What they do have on the scheme is so if you do use contractors, you'll have £1 million subcontractor cap. That's per game, and that's over the lifetime of the game. So if you're developing a console game, they can often take a number of years to develop, especially if you're one which you'll release and constantly developing afterwards. You will have a contractor cap of £1 million, which for many studios, there only might be smaller budgets anyway, so you won't have to worry about getting close to that. But if you grow the business and start, if you're in the process of doing a bigger claim, you might be influenced by the £1 million cap if you get there. We've got a few clients who reach that level. So, something to be aware of.
Mark, does that cap is what you're saying there? So if you're developing a game that then further down the line you port to PC from console or vice versa or something along those lines, is that all treated from HMRC's perspective as the same project, same game?
Yeah, ultimately, if it's the same game, then it would be. So just switching it from, say, a PC to a PlayStation or to a mobile, unless it's specifically a different project, a different game, it's likely to be viewed as the same game. So yeah, the £1 million gap might apply in that scenario. Yeah.
Okay, and just out of curiosity, going back to your other slide, sorry to
No problem.
interrupt here, but the sort of post-release development that you mentioned, can there
Yeah.
be a pause in this? I'm assuming you could potentially sort of release something, down tools for a year, for instance, and
Yeah.
then continue porting to a new format, perhaps. Is that all possible?
Absolutely, yes, absolutely possible. Yeah, so it's not necessarily there's not necessarily a time frame of that.
No.
They don't in the certification, which I'll touch on later with the BFI. There's no real restriction on the time frame. It'll be basically available as long as the tax scheme is available, unless they make any rule changes. But yeah, the post release, the development. So you might be 2, 3, 4 years before you decide, to do something different with the game and sort of redevelop it. It might be a brand new game you work on anyway, so you might need to do a new application for it. But if it's to sort of revamp an existing game and develop it in a new way, you still be able to claim those costs as part of the claim, even though it's been released for a number of years. You still potentially could make use of these schemes to give you a tax credit on that.
Fantastic. No, that's really, really helpful to know. Thank you.
No problem. So where did I get to? So yeah, I mentioned the subcontractor cap. So sort of might be relevant, but not so much relevant now because, as I say, this is the old scheme, and as I've got there on my slide, it's only available if production has commenced prior to 31st of March 2025. So obviously we're past that date. So this scheme is only going to be relevant for those who are already started production before 31st of March. If you're looking to start a brand new company and brand new game, this scheme that I'm talking about here won't actually be available to you. But if you have started production before 31st of March, you do have the option of using this scheme or the VGEC scheme, which I'll talk about after this. And overall, the scheme will finish completely for everyone up until March 2027. So we've got a couple more years where you can make use of this scheme. And it might be useful if you've got plenty of UK and EEA spend to use this scheme as much as you can. It's very much weighing up between which scheme is going to offer the best return for you, which one you use. And so it's available at the moment until 2027, when everyone will come off it and go into the new VGEC scheme. Which, just to give you a quick example of how it works in reality, a very simple one here. So a company which has £10,000 of core development costs, all incurred within the European area. So the lower of the two is whether it's going to be 80% of core costs, which is £8,000, or 10,000, which is actual EA spend. So you take the lower of the two, you take the £8,000. The payable credit you receive is 25% of that. So you surrender that for a loss and you receive £2,000 back from HMRC. So out of the original £10,000 cost, you will receive £2,000 back from HMRC. So overall, a 20% net recovery of that. Obviously, if you've got much larger budgets, you're going into £100,000 towards millions of pounds. It's quite a significant sum which you can get back. A fifth of your budget could come back to you, as a cash credit. So it's a hugely significant sum if your budgets are slightly higher than this. As a comparison, this example is using the same element of cost and how the impact of it being inside the European area. So this company, which has £10,000 of cost as well, only £5,000 of that is within the European end. So you take the lower of the two, you've got the 80%, which is 8,000, compared to actual EEA spend, which is £5,000. And so you take the £5,000 as your surrenderable expenditure. So you receive a 25% credit of that expenditure and pays you £12.50. So an £800 difference from the two companies. So that's the result really of how it works. The company one, which has incurred costs throughout the whole European area, claims 2,000. This company here, which only has half the costs in the European area, that's only able to claim 1,250. So that's generally how it works. So it becomes an important factor about the locations of your costs there. And VGEC will work something similar, which I will talk about shortly. Yeah, so video game expenditure credit. So this was the new scheme which was brought in. Essentially, it is going to replace the old VGTR scheme. So I mentioned it obviously is finishing at March 2027. When this one is going to continue, which is which is great news, because obviously when the UK left the EU, we always see uncertainty around for a number of video games clients is what going to happen to this tax scheme, because it was a European tax scheme, the VGTR, so that's why it was EEA spend for the relevant expenditure. So it's good news that the HMRC and the government continue to support video games, and they are carrying on this sort of tax incentive scheme for video game developers. And what they came up with was the video game expenditure credit. So this has come into effect from 1st of January 2024. I've put the transitional period. So there might be a scenario where you've got an accounting period, say to 30th of June 2024. You might decide to switch between VGTR and VGEC. So you can only claim VGEC on expenditure from 1st of January onwards. So you might have a case where you have 6 months claim on VGTR and the 6-month claim under VGEC if that's the more beneficial scheme for you. So that's might not be so relevant now, but you can go back and make prior year claims as well. So it's something to be aware of. You might have a transitional period. As I say, only expenditure from 1st of January 2024 will be eligible for this new scheme. So ultimately, how does this scheme work? So it's very similar to how VGTR works. You're looking at the 80% threshold again of total core expenditure. But rather than EEA spend, you're looking at actual UK spend. So they've replaced the EEA with the UK spend, which sort of makes sense in what they're doing because because of Brexit, they left the European Union, trying to promote UK businesses and UK employees. And the way to do that is obviously to try and encourage video game developers to look in-house at, staff available here and talent available here rather than overseas. It's not always practical to do that, depending on the talent pool that are available in the UK. But yeah, so they're trying to promote UK businesses. And what you receive for that is a payable tax credit of 34%. Now, on the face of it, it looks fantastic. 34% over 25%. This scheme's easily better than the last one. But it doesn't quite work the same because this taxable credit of 34% is a taxable income amount. The previous VGTR credit, where they paid you 25%, that was an after-tax tax credit. So there was no tax due on that credit you received. This one works slightly differently. So this is a before tax credit. So that 34% tax credit that you receive is going to be chargeable to corporation tax. If you're a loss-making business, what they essentially do is they take away a 25% notional tax credit. So you ultimately receive 75% of the tax credit overall. And so it results in a net credit receivable of 20.4%. So the last one was 20% net credit. This one's 20.4%. So it's very similar. It works out more or less all the same. The reason they brought this in was to try and balance out the effect of the credit compared with profit-making businesses and loss-making businesses. So either way, they will all receive the same tax credit, or this 20.4% tax credit from it. So yeah, it's still very similar, but the main difference to focus on is the UK spend rather than the European spend. My last point on that is to say they've abolished the subcontractor cap. So if you are working with UK contractors, it's good news for you because that £1 million subcontractor cap has been removed. So you don't have to worry about that anymore and being limited with that. To give you a quick example of how this one works, again, the same £10,000 core development expenditure. You're looking at the 80% enhancement at the £8,000 as the lower figure. The 34% tax credit results in 2,700 tax credit, which is then a taxable item. If it's a loss-making business, they take away the 25%. So essentially, they withhold £680 from your tax credit. What you with this withheld balance, if you've got taxable profits elsewhere, or you're part of the group and one of the group companies has taxable profits, you can actually offset that 680 against other tax liabilities, other corporation tax liabilities. So it's not necessarily lost, but or if you go to profit making in the future years, you can then redeem that 680 against future profits as well. So there's still an advantage to having that notional tax credit withheld, because you might be able to make use of it later down the line or part of another group company. So the overall effect is the £2,040 payment received from HMRC out of the £10,000. So that's your 20.4% recovery. So the previous one on that quick example was £2,000 recovery from HMRC. This is 2,040. So it's a slight increase if all of your expenditures in the UK. Ultimately, you will benefit from this VGEC scheme rather than the VGTR if at least, more than 80% of your costs are based in the UK. If more than 20% of your costs are based outside the UK, you start losing the benefit of the VGEC. So you might want to be on the VGTR if you've got that option as long as possible and you've got EEA spend, because the UK one, you might have contractors in France or Spain or whatever. You want to try and stay on that scheme as long as possible, in that if you're in that position where you've got European spend, so that's a quick example of how that works. So moving on swiftly to just generally how they work and how you apply for them. So claims are submitted as part of the company's corporation tax return. So it really follows your limited company accounts and your corporation tax return, which you normally prepare on an annual basis. So essentially, you would need to draft your account, draft your corporation tax return. You then add on the video games claims figures to that, and then you submit that on via the corporation tax return. The time frame in terms of submissions is the same as the corporation tax return. So you have 12 months to submit your corporation tax return, and then 12 months after that to submit an amended return. So really, you're working on a 2-year time frame to be able to submit your video games claim for that particular year. So if we had one for 31st of March 2025, the deadline in terms of making a claim for that year would be 31st of May 2027. So 2 years is the time frame really you need to get that in. If you do miss a year, if you're still, you can still go back and, as long as you haven't released and produced the game and done a final claim, you could still claim the cost at a later year. So for instance, if you've got a multi-year game development, say over 4 years, if for the first year you don't incur much expenditure, but the second year it really ramps up and you start, incurring much more costs, for that second year claim, you can still go back and claim the costs you incurred on the first year without having to do an amended submission for that one. So you sort of sweep up all the costs you've incurred to date. So it's worth noting there that even though you might not make a claim because there's only that small amount of expenditure incurred, you might be able to sweep it up into a subsequent claim later on, as long as you haven't finalised and finished the game and released it there. So that's something to be aware of. They also require something called an additional information form, which actually, unless you're doing the submission yourself, an accountant like ourselves would do the submission for you. Really, it's just an additional online form which HMRC asks for, just to detail, information relating to your claim and information about the company, addresses, people involved, that sort of stuff there. So not an overly complex. It's just ever since they've brought in the changes a couple of years ago, there's this form to submit alongside that. In terms of actually how you're eligible to make the claim, one thing you're going to have to do is pass the BFI Cultural Certificate test, which the BFI is the British Film Institute. So they basically administer all the creative sector tax claims. So it could be film, TV, theatre, animation, all those sorts of claims all go through the BFI. So to be able to be eligible to make a claim, you have to verify that your game is culturally British. So to do that, you need to achieve take this test, and they do a test based on 31 points split into 4 sections of cultural content, contribution, hubs, and personnel. And you need to have scored at least 16 points out of the 31 to be eligible for that. And you need to have the certificate to be able to submit your claim. They would reject the claim without that certificate. So it's quite crucial that you, at some stage, you don't have to do it from the very start, but at some stages you're nearing maybe the first year and you've incurred a load of costs and you're planning to do a claim, it's worth getting your cultural certificate done before the year end to make sure that you've qualified and you've passed the test and you've got that to hand, rather than waiting around trying to get the certificate before you can do the submission. What they do is you can do claims at interim and final stages. So you can, if you say you've got a 4-year development cycle for your game, and you could do interim claims at year 1, year 2, year 3, year 4, and a final one year 4, or you can just apply for a final certificate and do one at right at the very end of year 4. You've got the option to use both. Quite often we find interim claims to be quite useful because it helps with cash flow to do that after 1 year, after each year. Or if you've not got huge amounts of expenditure year on year, but overall, over the development cycle of the whole game, might be worth claiming, you might just do it on the final certificate there. So two types of certificates which you'll get from BFI. One bit of advice around the cultural test is when you are applying for your final certificate, you apply for the points in different sections. If you have received points in section C and D, which are the hubs and personnel sections, you do require an accountant's report to verify the expenditure you're claiming for those sections. So it's always best to try and earn your points in sections 1 and sections 2, which are the cultural content and the contributions. That's things like having an English setting or use of English language, something along those lines. That's always useful to claim points in that section before moving on to section C and section D. If you haven't earned enough points in section A and section B, I'd move on to section D, which is the personnel one. So it's like having an English lead writer, English director, English animator, those sorts of things there. That's less work than it is on section C. So at the very last resort, go to section C to get the points you need to get that 16, but try and do it A and B sections rather than C and D if you can, because an accountant's report will cost you a few £100. So it's not huge sums, but it's an additional cost that you probably could avoid if you've got enough points in sections A and sections B. Once you've released the game, you must apply for a final certificate. Or if you don't reach the point where you're able to release it and you decide to abandon the project, you need to apply a certificate to say that you've abandoned the project. HMRC do have the authority to go back and reclaim any tax credits paid out if you haven't applied for a final or abandoned certificate. So whatever it is you get to the point of the game, once you've released it and it's available for sale to the general public, make sure you get your final certificate authorised by the BFI. It's another application you do online. The BFI team over there are very helpful. So if you have any questions regarding the application, you can always get in touch with them and they're always happy to assist with you. So yeah, always feel free to speak to the BFI team. But yeah, crucial that you get the final or abandoned certificates depending on where you get to with your game development. So once you've got your cultural certificate, once you've prepared your claim, once you've submitted the accounts and submitted the corporation tax return, how it gets processed is the HMRC creative sectors team. They generally aim to deal with claims within 40 days. So fair amount of quick turnaround with these claims. From experience, they tend to be sort of 6 to 8 weeks generally. They say 40 working days is their limit before you can contact them to find out what's going on with the claim. They're a very small team, the creative sectors team. So how quick they do in terms of turnarounds really depends upon their workload. You also have the issue potentially they can, like with any tax scheme or anything with HMRC, they can always raise compliance checks on your claim. Always try and avoid that as best you can. It's not always avoidable, but make sure your claim is airtight as possible, because compliance checks with them are very frustrating and long drawn out process. We had one client a couple of years ago. It's fairly complex structure they were doing with the claim because they had a group structure going on, and it's a fairly sizable claim. It's only £1 million in tax credits being received. However, that one did get caught by a compliance check, and it dragged on for about 18 months, which was a big significant issue for our client with cash flows and all that sort of stuff. It was mainly the issue was the speed that they worked was just not great. You respond to them fairly quickly in a week or so, and they take several weeks to get back to you. They come back with more questions, and it's just a long drawn out process. So make sure your claims as airtight as possible. Say most of the time they're pretty good. They go through without a problem. But if you do get a check, they do be prepared that cash flow wise, it might take a long time before you actually get it in. And then once you've processed the claim, after that, they generally do a bank transfer to refund you. So it's pretty quick after that. There's often a security check on the bank transfer, but again, that's usually a formality. It takes another week or so to get processed there. But yeah, and that's that's how it works, the application. Moving on slightly to another couple of considerations that you have relating to video games. So there's something called special purpose vehicles, or SPVs for short. So this is essentially group structures. So an SPV is created to oversee a creation of a particular game. So I mentioned before about the compliance check which HMRC were undertaking. This related to an SPV structure. So an SPV structure works by trying to, essentially the benefit of it is trying to isolate one game development in one company, another game development in another company, trying to separate it out from all of it in one company. You have a specific company set up to develop one game, you have a specific company set up, create number 2 game, and that sort of stuff there. So it's trying to separate the financial risk and simplify that in administration process. What generally happens in these types of arrangements is usually have the parent company, which is usually the ones which has the staff members, so it has a payroll running through. What happens is that company, the parent company, will lend staff to the development company and then raise invoices between the parent company and the development company for lending the staff, so a staff lending arrangement. In turn, the development company will then raise invoices to the parent company for development services. It can get quite complex, and it's important that if you do ever touch upon this subject of SPVs, that you get the appropriate legal advice in place, because, as I say, they are a hot topic to look at for HMRC. So if you do ever go in that SPV structure, make sure you've got the proper legal agreement set up in place. What they do in those arrangements, they charge a man-month rate for the staff lending and development services. So it's important that if you do use a man-month rate, you're not just inflating it for the sake of the video game claim. You actually have evidence to show the man-month rate that you've chosen is legitimate. You've got supporting evidence, because HMRC will definitely challenge the man-month rate that gets applied between group companies, because essentially you're charging between group companies, but you're not charging on a cost basis. You're charging on a man-month agreed price basis. So it's important that that agreed price is set at a suitable level and not too high, to make sure that it's, it won't fall foul with HMRC. That's so something to be aware of. And one thing else in relation to other video games considerations is withholding tax. So once you do release your game, and you might be using platforms like Steam or the iPhone platforms or Play Store, things like that, PlayStation Network, Microsoft Network. Often you'll be selling, you might even be liaising with publishers in America and overseas. You might come across double taxation arrangements. So where you're trading with either companies or selling to individuals in other countries, the authority that you're selling to might try and impose taxation on your sale proceeds, because you're a UK established company. Your tax liabilities lie with the UK and nowhere else. So to avoid this happening and avoid them withholding tax from your income, you want to make sure that you have the appropriate forms in place. And for America, it's called the W8EANE form. So if you ever set up an account with Steam, they'll often ask for that form to be completed. A res form is a residency certificate. So it's something you apply for from HMRC to verify that you're a UK established company, and then your tax liabilities arise in this company and nowhere else. So that's something to be aware of if you do go and sell on different platforms. You might get some tax authorities trying to withhold some of your money from your income. So if you have these forms in place, you can ensure that you don't suffer that tax withheld situation. Also, considering a few aspects, funding is one of the big crucial points relating to video games development, is how you're going to fund your development. One thing you can make use of if you are developing something called tax credit loans. So this is a loan where your security is offset against the video games credit. This mainly applies for larger claims, because most video games tax credit loans only offer loans where it's a tax credit of £100,000 or more. So at least 500k of development expenditure. So it's a fairly sizable sum. Again, it's mostly for cash flow considerations. If you know you're going to get a video games tax receipt in the near future, but you find you've got sort of a gap in your funding and a gap in your budget, you can find providers who provide you a loan on the basis of this tax credit you're going to receive. Most video games claims are fairly secure in being processed. As long as you've got the BFI certificate, you get an accountant, suitable accountant to review the expenditure, is almost certain that you're going to get that claim authorised and paid through. So it's quite a secure way of getting funding if you've got a short-term cash flow issue. Again, it's mostly for bigger budget setups there, but it's worth looking into if you go into that that level of expenditure. On the smaller scale, you might come across grant funding. So what that means, if you get grant funding to use on your development of the game, it doesn't necessarily mean that you can't make video games claims. So you might receive grant funding from various different UK gaming organisations out there that offer grant funding. If you receive the funds and then use it towards, staff wages or subcontractor costs that you're using for your development of the game, that expenditure is not excluded from the video games claim. So you can still make a claim on that expenditure that you've received, that you've spent and used the funding towards. So you can still make use of the video games claims, even if you're sort of funding it from grant funding there. Also, in relation to sort of funding, you can look at investment schemes. So you obviously, when you're looking to develop your game, you've got to try and think, well, what's my budget going to be for the game? What do I need to how much money do I need to bring to get this to release point? So one of the things you can do is get external investment. One of the ways to make yourself more attractive to an external investor is to look at EIS and SEIS schemes. They're essentially enterprise investment schemes. EIS offers, basically, they offer tax incentives to those investors. They basically get a reduction in their tax liability by investing in these companies. And they are specifically built around small, startup companies, growing companies, and a way to attract investment in those companies. So EIS, if you're within 7 years of trading, you can apply for an EIS scheme. SEIS is within 3 years, I think, from the first sale. EIS offers investors a 30% clawback on their investment. So if they invested £10,000 in the company, they could reduce their tax liability on their tax return by £3,000. For SEIS, you get 50% back, so it's more attractive. But obviously, SEIS has a shorter time frame, so it's not necessarily the most attractive for video games sectors, because investors like to see a sort of a steady flow of revenue and building up the trade. Whereas, video games, you might do a game, you might do well, and then it sort of drops down, and you got to wait for the second game. So lots of roller coasting going up and down, really. There's no guarantees that the second game you release is going to achieve as much as the first game, or vice versa. So they're not always achievable, but you might find yourself, if you're in talks with investment individuals or companies, and they say, do you have a EIS, SEIS investment scheme up and running? It's worth looking into, because you make yourself more attractive for those investors to put their money in. And relating to that, sort of, you can look at EMI schemes. They are enterprise management incentive schemes. If you've got some developers who are working for you and they're quite crucial to your company, and you're looking to try and keep hold of them, retain them, not lose them to anywhere else, or lose them to your own company, you can look at EMI schemes. It's a way to try and incentivize them to stay with the company for a long term and help it grow, because essentially give them share option grants at a certain date for the market value at the time. As long as they stay with the company with 2 years, they then get no tax or national insurance implications on issuing those grants to them. And then once they sell the grants, once they get issued the shares and sell the shares afterwards, they get incentivized tax benefits from that as well. So something you can use if you've got someone quite crucial to your organization and you want to try and, one, motivate them, and two, try and retain them in the company. You can look at certain schemes like EMI schemes to try your best to keep the talent in your organization. So I'm just going to move on slightly to a slightly different subject of VAT, just to give you a brief overview of VAT. So that registration threshold is £90,000 of sales. It's not profit, it's sales turnover. This is on a rolling 12-month period. So if it's a case of it's not based around your accounting year end, it's any 12-month period you're working towards. So if you're getting close to the £90,000 threshold, say for instance you're working on judging by January to December, if you're just under, you might be 85,000. Then next month you have to check what's your sales turnover between February and January. It might be 87, even closer. Then you go to March to February, and it's always a rolling 12-month period. It's not based on your accounting year end. It's based on a rolling 12-month period. So something to be aware of. What counts towards that registration threshold is quite crucial. So that £90,000 threshold is only looking at UK sales. It's not looking at your non-UK sales. So purely UK only sales looking at. So you might provide services to a US-based publisher, but that revenue is outside the scope of UK VAT, so it doesn't go towards your threshold. So you only look at UK only thresholds. If you need to register, it's a simple online application, just various different bits of information when you want to apply the registration for. So it's quite easy to do online. Once you are registered, they send you out a letter confirming what your VAT number is. You then have a choice of doing either monthly, quarterly, or annually, which you actually submit in the application. Generally, most companies will use quarterly returns. It's the most common way of doing it. Monthly is quite an administrative burden. Doing 12 submissions for the year is quite time consuming. In the same way that annually, even though you have one return for the year, you actually for annually have to do like advanced estimated payments for VAT. So it's not always advisable to do that. So probably quarterly is the most common and most used system for submitting VAT returns. How you actually submit them, you need to have a Making Tax digital compliance software. So something like a Xero or a Sage or a QuickBooks, something like that to maintain your record, something with a digital link that you submit using that. So online submissions, there are ways around it if you only have spreadsheets, but if you're at that level to need VAT returns to do, it's worth having a software which is compliant to be able to submit it. Just to give you one quick tip regarding voluntary registration. So I mentioned before that UK sales is outside the scope, non-UK sales is outside the scope. If you are incurring a lot of VAT on your expenditure, if you've got a contractor who charges you VAT on their sales, there's nothing stopping you even if you're not above the £90,000 threshold, to do a voluntary registration and claim the VAT back from the VAT you've incurred. So you incur VAT from accountancy services, from legal services. Some subscriptions might charge you VAT depending on where they're from. If you're in that scenario, it'd be like, well, I'm incurring this VAT and I'm not charging VAT to anyone. I still might, as long as you're in business, you're able to register VAT voluntarily and claim that VAT. So it helps you sort of cash flow really to do so. So it's worth looking into if it's worthwhile doing. Because as I say, I've seen that a number of times where clients are voluntarily registered to claim back the VAT they're incurring on their costs. There's nothing wrong with doing that as long as you're legitimately in business. So no issues with that one. Quickly, some brief overview of I've talked a lot about limited companies, how you set that up. So you do an online submission. There's lots of limited company formation companies out there who can do it for you on a fairly ranges from £100-ish, something along those lines. Basically, you have to issue a number of shares between you and any other investors or shareholders that you start out with. Commonly, you'll be like one share per, £1 one share, or £1 100 shares, something like that. Just don't give yourself £1 million worth of shares, but for £1 each, because then you've got to basically subscribe for £1 million of shares. So do £1 100 shares or £1 one share. That's the easiest way to do it. An idea of other taxes you'll be liable to. So you'll have corporation tax if you make profits from other activities. You might do contracting on the side and do video games development somewhere else. If you make a profit overall, there'll be a corporation tax due on that. If you take on staff, you'll have PAYE taxes. So you'll have employers' national insurance. In April, they raised the national insurance rate for employers, so it's becoming more and more expensive. But what they do give you when you're a small company is the employment allowance, a 10k employment allowance. So hopefully that reduces some of the liabilities that you face with employers' national insurance costs. But yeah, you'll be responsible for submitting POA on a monthly basis if you have employees, and obviously pay across the taxes on their behalf. So yeah, that's something you have to be aware of. In terms of submissions, so I've mentioned before about the accounts and corporation tax return. You do that on an annual basis. The accounts have 9 months after year end to be able to submit those. So that's the main deadline that you have. And if you do have corporation tax payable, it's 9 months and 1 day after the year end. So 9 months is your key deadline there, really, for most accounts year on year. And just a quick one, really, on tips to how to manage cash flow. It's really, really important that you sort of budget with your development. Cash is king at the end of the day with video games development. You don't want to get halfway through and find you've got no funding left to be able to do it, or scrambling around to try and find financing for it. You might have to put things on hold if you've got staff. It might be severe case of redundancies, those sorts of things for the video games sector. It's really appreciate trying to get funding in video games is quite tough at the moment. It's not the best place for the video games sector at the moment, but obviously there's still money out there. It's just they've just reined it in a little bit. But trying to work out, doing monthly forecasts for the next year, next 2 years, just so you know what money you got coming in, what money going out, really will help you a long way in terms of reaching the goal of getting to that final stage of releasing your game. So certainly, cash, make sure you've got a good grasp on someone in your organization, even if it's not yourself, someone in your organization has got a grasp on the cash flow to help you with your game development there. So it's very crucial. And yeah, I think I've covered a large number of topics. I hope it was helpful, but I'll be happy to take any questions if anyone has anything they would like to ask.
I think that was incredibly detailed, actually. Mark, thank you so much for that. I think from your perspective, game developers and studios, they might feel like they're essentially sort of reinventing the wheel every single time. Everyone's got to learn this stuff for the first time. You're obviously dealing with this on a fairly regular basis, especially given Plus Accounting's sort of specialism here. What do you see from your side of things that people are just falling down on, or sort of generally misunderstanding a little bit, or not, or could do better, basically?
Yeah, I think a lot of it's just awareness of these things. As I say, the amount of times we come across a video games client, a new client, and they're not aware of the video games claims, or they're not aware, as you asked previously, around the post-release claims. It's having awareness to say that, even though you've released the game, you still got potentially might have costs you're able to claim. And, it's the type of expenditure you're able to claim. It's those sorts of things that they're probably not aware of. One thing as well is to make sure that you've got your setup correct from the get-go. I've not seen them too often, but there has been a case before where we've had a client who's released the game on Steam under their own name. And it did fantastically well, which is great news. But they released it under their own name. So they had hundreds of £1,000s of income, and it was mostly all profit from this game. It was a fantastic result for them. However, they wanted to then put it into a limited company to then, have more flexibility about their own income, draw dividends as and when they want to. They didn't get the choice with that because the game's already been developed, it's already been released. They've not had the structure in place from the get-go. And unfortunately, it's then resulted in a higher tax bill for them because they've obviously just couldn't have planned ahead to know that the game would do as well as it did do. But yeah, it's important to get your structure set up. A lot of the time, we work with a lot of individuals who are doing stuff on their own time. They're working full-time employment in the game industry, contracting for their own company, and they're working on a video game on the side. It's identifying the point where, at what point do you move that game into a limited company structure? Because there's costs associated with limited companies, there's administration associated with it. It's a lot to take on if you're not used to running your own business, and it can be quite daunting. But ultimately, most of the time, you are still doing the work you like doing in terms of building your game and that sort of stuff. That it might put people off the administrative burden of being a director shareholder of your own company. But apart from a few things throughout the year, it's not too scary, not too troublesome. So it's about finding the right time to move your side project into a limited company, and get the go ahead and doing it, and just not be too afraid to take that on. Say if you get enough support from an accountant throughout the year, you can always, as I said before, there's no stupid questions in this game, so you're always learning. So always feel free to ask questions, and then really, that's
Absolutely.
the most common things we say.
Yeah, definitely. I'm pleased to hear that. It's a really, really good answer to that question. Fantastic. Well, we don't have any other questions in the chat. It seems like everyone's been really happy with what you've talked about. So yeah, it sounds like you've covered absolutely every eventuality there, apart from the couple of questions that I
I
had.
tried to. Yeah. But I appreciate
That's really,
everyone
really
listening
helpful.
on an afternoon. Obviously, if you have any questions afterwards, feel free to follow up. I'm sure Leo can share my contact details. They are here as well, but Leo can share my contact details. I'm always happy to ask any questions if you have any follow-up ones.
Absolutely. No, that's really, really helpful, and I'll pop those details on the video as well that we'll be uploading to YouTube. Thank you so much, Mark. Thank you so much for your time, and thank you so much to everyone that's come along. Hope to see you again very soon, and I hope that was really, really useful. I certainly found it fascinating. Lots to consider there. So yeah, thank you so much. Appreciate it.